Next, we'll look at the term underlying. This is where the actual value of the futures contract comes from. When you get a futures contract, everything is standardized, particularly the quantity, and the value of your futures contract moves up and down based on the underlying goods, whether they be wheat, soybeans, or S&P index. So the underlying is the actual price fluctuations that they're following. Next, we'll look at hedge. Hedge positions, or hedging, is holding simultaneously a cash position along with a futures position. This is the reason why futures was created in the first place, to protect hedgers as a form of insurance. And hedgers are the primary users of the futures market. Second, we look at speculators. These speculators, who are you and I, are the ones who actually profit from price change. That's it. There's no other way to profit from futures investing but through price change. So, as speculators, our goal is to create liquidity for the environment of the hedgers and to find price discovery. More terms defined. The contract. This is the exchange agreement that is traded amongst sellers and buyers. Because contracts are not held forever, similar to stocks, they're held on a short-term basis, typically quarterly. Contracts tend to be very detailed in what the quantities are going to be, what the amount is, and the actual goods and services that are being provided, whether they're S&P or Euro dollar or grain futures. Now, many people who invest in stocks and commodities understand already the terms long and short. Long is basically buying a market position, and short is selling a market position. What is unique to futures is that the shorts and the longs are treated equally. There is no favoritism. There's no one uptick rule against the shorts. Shorts are able to come in at the market at any time, and they don't have to deal with borrowing like stocks do, and there's no interest to be paid. Immediately, if they believe the market is going down, they're able to come in. Also, what is unique is initial margin. Margin in futures, unlike stocks, is a performance bond. There is no actual item being purchased. It's a good faith deposit against your control of the price change. So you may only put up anywhere from 2 to 5% of the total value using margin to get started. So initial margin is very important. Then there's secondary type of margin called maintenance margin, in which if the price change is moving against you, there's a minimum level of funds that need to be available in order for you to hold on to that contract. And if you dip below maintenance margin, then you're automatically required to come up again with a full new margin. And we'll talk about this later. This is a very unique instance that happens in futures. And lastly, open interest. This is the total number of contracts that are being traded at any given time. So there's always one item of open interest for both a futures buyer and a futures seller. Open interest is very important, and it shows all of the fulfilled contracts. Now, we mentioned earlier that futures originated from forward contracts in the early 1500s in the United Kingdom, as well as many other places. And we'll explain why futures differ from forward contracts, because today forward contracts are traded on many markets, whether you trade foreign exchange or gold forward contracts. So there's a slight difference, but they're very important. One is the rules of conduct. There's an actual exchange that trades futures contracts, and so there are specific ways that investors are required to buy in and to get out. Second, organized marketplace. Forward contracts have no organized marketplace. Usually they deal with, especially with foreign exchange, interbank dealers offering spreads and prices, whereas futures deal specifically with particular locations. In the United States, most futures trading involves Chicago. Chicago Board of Trade is there, the Chicago Mercantile Exchange. There's also other places like the New York Mercantile Exchange, the COMEX, which trades gold in New York as well, and the Kansas City Board of Trade, along with many other smaller markets. So there's actually places that the contracts are being traded. Standard contract specification, number 3. In forward contracts, a contract can be designed any way two parties see fit. In futures, the contracts are all identical, so that even when hedgers decide to use futures contracts, there are discrepancies from the actual wheat or grains they may be selling locally from the actual futures price, futures grains contracts that they are trading. But the discrepancy is acceptable because they know that everything is standardized as far as price, quantity, and actual trading capabilities. 4, a focal point for information. In the futures market, the futures exchanges operate as the clearinghouse for all of the information that is going on, whether it be weather-related, whether it be new information from the Federal Reserve Board and Greenspan. Everything comes straight to the exchange, and it's represented by how the sellers and how the buyers operate. In the forward market, you don't have that same kind of transparency and information. 5, there's a mechanism for settling disputes. This is important. Although a small number of contracts are actually delivered in futures, in the futures exchanges, that small number still needs to be protected because this is an insurance development. Futures are insurance for hedgers who buy and actually produce the goods. So they have to, sometimes there's discrepancies and disputes between contracts and how things operate, and the exchanges are able to step in and settle those disputes. Also, for the speculators who participate, there's actually governing bodies that they can go to complain to if there's something wrong. So it's a great mechanism to settle disputes. And then lastly, guaranteed transaction being the exchange clearinghouse, which I mentioned earlier. Every trade is protected and guaranteed, so you never have to worry if your money is going to be there or if you're going to get paid for your contracts. Now, how futures differs from stocks and stock investing. Number 1 is ownership. When a person buys one share of GE, they own it for life. Whether the price goes down or goes up, it's actual equity in the company. There's no such luxury in futures. There is no ownership component. So when you invest in futures, you have to realize that you're actually buying into an agreement that you're obligated to fulfill if you hold on to the contracts too long. And since there is no ownership component, the actual money that you put up is treated differently. So when you buy stocks, if you buy $10,000 worth of stocks, you may have to put up $10,000 worth of cash in order to purchase them. And in futures, doesn't operate that way. When you have a contract that may be totally valued at $15,000, you just have to put up a performance bond for that agreement, maybe 2-5%. And at any time you decide to be out of the agreement, you're able to offset your position. Second is daily account balances. With futures, because speculators profit solely from the change in price, every time the price moves 1 cent or $1, either money is being added to your account or money is being taken away from your account. There's no ifs about this. It happens immediately, and it goes directly from someone else's account to yours. And this is what is meant when people talk about futures being a zero-sum game. When you invest in futures, your profits show up immediately and your losses show up immediately. And you have access to those funds at any time. Shorting. In stocks, there's the one uptick rule, which stops people from shorting immediately. But also there's an entrenchment in American society which is highly against shorting, period. Many people believe or blame the crash of 1929 was because of shorting in the stock market. And so since then there's been a negative atmosphere of shorting in the stock market. Well, this just doesn't exist in futures. Longs and shorts are given the exact same respect. And so as a new futures investor, always look at your options on both sides. Don't be afraid to short the market because there's actually nothing holding you back. Lastly are the regulators. Futures are regulated by 2 different groups. Number 1 is the Commodity Futures Trading Commission, the CFTC. The government set the CFTC up in the 70s solely to regulate futures, and they're a very strong governmental body. So similar to the SEC, they protect investors from unscrupulous brokers, unscrupulous trading, and insider trading maybe from floor traders. So it's a very regulated market.